So junior mining companies, junior resource companies, we face the same energy challenges as all mining companies. Whether you're building a mine in the Free State, such as ourselves, or in the sands of the Kalahari, or in the Northwest Territories of Canada, or anywhere else in remote locations in this great continent of Africa, we all face questions of energy costs and security. However, junior companies have to face the challenge with an extra disability. We're always short on cash. So in this morning's presentation, I'm going to try and give you a small insight into the life inside a junior resource company and how it differs from that of a major. And in particular, I'm going to concentrate on how a typical junior has to address capital allocation decisions, including energy sources. So when I was first asked by Adrienne to give this presentation, I was somewhat hesitant, as I really have very limited experience with the renewables sector in terms of hard investment. And while I've been involved in for more than 20 years in developing small to medium-sized mines, often in remote locations, for the last 10 years I've been involved or based and involved in the redevelopment of the Lace mine in the Free State. So the Lace project is grid-tied, Eskom grid-tied, and so we have made no investment at all in renewables. So I had to ask myself, what value could I add at all to this conference? And then it dawned on me that, that indeed was the point of the presentation. Why is it that a CEO managing a 700 million rand investment reopening a 25-year diamond mine in a country with the energy challenges we all know we face has no real experience with renewables? And the answer would be echoed by almost all CEOs of junior companies, that at this point in time, the answer goes to the very heart of what makes a junior different to a major. And here it is. This statement sums up life for us in the junior mining industry. All too often we're just one unsuccessful financing away from running out of cash. Junior mining companies are typically companies with market capitalizations of less than R1 billion, and oftentimes much, much less than that. Usually we have one or two resource projects which require constant capital outlay until such time as they are generating positive cash flow. And raising cash for these small cap junior resource companies is extremely difficult. At varying times and for the right project, and when the boom is on, funds can be raised in London, Canada, and Australia, and usually and almost exclusively from investors with high risk appetite. But here in South Africa, it's almost impossible to raise capital for juniors. So as a CEO of a junior resource company based in South Africa, we spend a lot of time on aeroplanes talking to investors in the City of London. So the cash constraint is the real differentiator between juniors and majors. During exploration and development phases, we are always short of cash. Majors sometimes get short of cash as well, but it's a bit different when you're down to your last couple of 100 million of cash and undrawn credit facilities, versus a junior company which could be a week away from insolvency unless you get the next placing completed. So that's the sort of cash pressure that we're under all of the time. Therefore, the management teams in these companies have to be extremely careful about how cash is spent, and it's at the forefront of how we run these companies on a day-to-day business. And capital allocation decisions then tend to be based on expediency, and that's the driver. In other words, spending the precious cash that we manage to raise has to be on the basis of what is the cheapest route to getting a project to positive cash flow, rather than what is necessarily the best investment for the life of the mine. And that's why CEOs of junior resource companies to date typically have had very little experience with renewables. The upfront capital investment required for renewables is simply going to cost more than tying into an Eskom grid or renting diesel gensets. And for this reason, upfront investment in a new mine development by a junior is almost unheard of. However, over time, and from what I've been hearing this conference, in the not too distant future, I hope, I suspect that this may change. For those not familiar with the life cycle of a junior mining company, this slide shows the typical timeline involved in bringing a junior resource project into production and that all-important positive cash flow. And be aware that this is the life cycle of those very small percentage of junior companies which are actually successful in finding a project which ultimately turns into a mine and into positive cash. Most junior resource companies fail to find a mine. So all the risk capital that's raised is lost. And that's why it's so difficult to convince an investor that you have the project that's going to work. So on the horizontal axis here, we have time, and on the vertical axis, we have value. And by value, we mean share price and market capitalization of the company. So for those small percentage of juniors with a good project, you can still see the ups and downs of trying to raise capital, typically over a 7 to 10 year period from exploration through to development. In the early years, a few high-risk investors provide the seed capital required to secure an exploration project and fund the early stages of exploration. In most cases, unfortunately, the exploration is not successful and the company has to recapitalize and find a new project. Or the company goes out of business altogether. Then, when a discovery is made, there's a rush of enthusiasm. The speculators come on board, push the stock price to 5 or 10 times more than the original value, and finally, the high risk of the early stage investment has been rewarded for those investors. However, they know that we're just about to face a period of uncertainty as the reality sets in about the timelines involved in permitting a new mine, completing engineering studies, and banking and ultimately building the mine. And at that point, we enter what we call the orphan period, when investors lose interest as timeframes lengthen, delays incurred, news flow becomes routine, and so the speculators sell out so they can invest in their next exploration hopeful. Meanwhile, building the mine, particularly an underground mine, is beyond the attention span of most investors. And it's always particularly tough when you're doing it on a budget. So in the dip of the orphan period, the last dip there before the rise, the biggest struggle in that period is trying to arrange the project finance. But once project finance is arranged and the project development gets underway, you start to move towards the ultimate goal and what it was about in the first place. So the mine comes into production, targets start to be reached, then institutional investors will come on board, the stock price gets a final upward re-rating, and at that point, 7, 10 years from the start, you get to that holy grail, the all-important positive cash flow. So, why is it that juniors struggle? Well, essentially, bankers hate uncertainty. Uncertainty equates to risk, and banking is all about trying to price risk. Regrettably, junior companies and junior diamond mining companies in particular come with lots of uncertainty as far as a banker is concerned. 5 risks most problematic for us in trying to raise finance is resource risk. How much drilling has been done? How confident are you in the quality of your resource? Market risk. What's happening with commodity prices? Are the Chinese in another bubble? Recovery and metallurgical risk. Will the plant work to design expectations? Project execution risk. Does the company have the right people? Sovereign risk. How certain are we of royalties and tax regimes or BEE requirements? There are many other specific risks on a project-by-project basis, but any one of these 5 can be a deal killer when it comes to banking a resource project for a junior. So in the absence of bank finance, the junior has to resort to dilutive equity capital, or costly mezzanine financing methods, hybrid loans, convertibles. And so in doing so, the junior resource company usually just scrapes together enough capital to get a project into production on the thinnest of shoestrings. So up to now, if we were then to suggest to our bankers or financiers that along with all of these risks, we're going to incorporate a large-scale renewable project as part of the mine startup, it's hardly likely to enhance the investment case as far as the banker is concerned. So if all of these risks aren't enough, sometimes timing is just lousy, and you get hit with an externality from left field. Diamond Corp was just putting together the finishing touches of a 320 million project finance facility in August 2012 when a strike broke out at Lonmin's Marikana mine. Regrettably, we all know what happened next, and needless to say, in the wake of the negative headlines that shot around the world, that particular financing fell apart. It then took us another year to get the finance in place, thankfully with the assistance of the IDC and from Tiffany, the diamond company out of New York, in a debt for offtake agreement. So running junior companies it's not for the faint-hearted. And given the constant cash constraint experienced by a junior, it's no surprise then that capital allocation is driven by expediency, as in not what is necessarily optimal for the life of the mine. In our case, we're developing the Lace kimberlite pipe near Kroonstad in the Free State. Lace was originally mined 1900 through to 1931 and was then becoming one of the more significant diamond producers in South Africa when diamond prices crashed in the Great Depression in 1931. De Beers then bought it, and they bought it for one reason, and that was to keep it shut as part of their control of the supply side of the diamond industry. And that's the way it stayed for the next 75 years. In the old days, it was mined initially by open pit and then underground to about 220 meters. Since Diamond Corp got control of the project, we've drilled it to 855 meters and demonstrated that we have more than 33 million tons of kimberlite, containing more than 13 million carats of diamonds with an in-gram value of about $2 billion US. So this is going to support 25 years of underground mining. After finally getting our finance package together in the first quarter of 2013, we've developed more than 3 kilometers of tunnels down to the 310 meter level where we're starting our first mining block. Before starting that development, we had to make some life of mine decisions. The most important of which was how we were going to access the ore body and hoist the kimberlite to surface. Traditionally in South Africa, most mines have a vertical shaft or had a vertical shaft. In other parts of the world, decline tunnels with conveyor belts has become more common. So we did a trade-off study between the vertical shaft and declines with conveyor belts and ultimately settled on the conveyor belts. Interestingly, this decision was partly driven by expediency and partly by optimal life of mine capital allocation. We decided on declines with conveyor belts because the development cost and time to development was roughly the same for both the shaft and the decline. However, the life of mine, there's a considerable OPEX saving using conveyor belts, as energy consumption is approximately 1/3 of the energy consumed by the winder in a vertical shaft to the same depth. And importantly, conveyor belt power requirement is also far more constant than the peak demand of a winder stopping and starting. After life of mine capital decisions came startup capital decisions. Firstly, trucks, rolling stock. We were going to buy second-hand loaders and trucks or new ones. Here's second-hand one out. We bought a fleet of second-hand units at a fraction of the cost of new units and developed in-house the skills to pull them apart and do full rebuilds every 5,000 hours. So we can rebuild these units with OEM exchange rebuild components in about 120 days at a quarter of the cost of a new unit. So even though we knew we would we would not get the availability of new machines, we do get close to 80%. So factoring in this reduced availability, the total rolling cost expenditure to reach positive cash flow has been considerably less than the combined purchase and operating costs of a new fleet. The second big capital decision was power source, Eskom grid tie versus renewables. Well, here I'm kidding, because to be honest, 3 years ago when we did our feasibility study, this wasn't even discussed as an option. And today it probably wouldn't be either. However, in the future, we must be reaching a time where it's going to be. Already it's being discussed as a trade-off for remote off-grid projects. And in the longer term, it must be part of the feasibility studies for any mining development, particularly if the capital cost of renewables keeps coming down and the Eskom tariff charge escalation keeps increasing. So on the back of these expedient capital allocations, we are now close to commencing commercial production at the Lace mine and reaching that all-important positive cash flow. But let's just consider that our project wasn't in the Free State and that it was somewhere off-grid. say it was Central DRC or Angola, would we have done anything differently? Shaft versus decline, the answer would still have been decline. New versus second-hand rolling stock, probably second-hand, but it would have been a closer call. Energy sources. In the case of energy sources, certainly more work would have been done on the role of renewables, diesel versus renewables. I suspect the answer would still be a startup with conventional energy, but looking closer at introducing renewables as a second stage investment after positive cash flow is achieved. And that is in fact exactly what's going to happen with LACE as well. To be a junior mining entrepreneur, you have to be part mad, part masochist. But every now and then, it's worth all of the pain, and this slide explains why. This is the LACE life of mine economic model. The vertical bars represent the carats of diamonds forecast to be produced each year from now until 2040. At peak production will produce up to 500,000 carats a year at an operating margin better than 50%. At current prices, that gives us $80 million US a year of revenue and net profit after tax of more than $40 million US a year. The black line is the project net tax, the project after tax cash flow, which totals more than $1 billion over the next 25 years. The yellow line in the bottom corner is the external debt repayments that have to be made to the IDC and Tiffany over the next 4 years. So the difference between these two lines, this considerable difference, is the surplus cash flow. As you can see, the project is going to be hugely cash flow positive. However, we're also acutely aware of the current and future Eskom price increases, which have the potential to erode our margins. Our total power requirement at full production is about 6 megawatts, with power at current tariffs representing about 25% of our project costs, for our production OPEX costs. So while we have got into production with an expedient allocation of capital, it is critical that once we've achieved this positive cash flow, that we review those capital allocation decisions. And this would be the same for any junior, whether you're operating in South Africa, Angola, Canada, or Australia. A good example we've seen recently was a decision by Sandfire Resources, mentioned by Adrian then, in Australia to co-invest in a 10 megawatt solar renewable plant at its De Grusa copper mine in Western Australia, after having achieved a few years of solid cash flow in a conventional startup using diesel. To me, capital allocation decisions are the most important decisions a CEO of a junior has to make. In our case, expediency has, as I had said, has driven how you get the project into production. And then once you're in positive cash flow, equally, how do you allocate that capital? So firstly, we'll be paying back the IDC and Tiffany, and simultaneously we'll start to give cash back to our long-suffering shareholders in the form of capital returns, share buybacks, and dividends. And thirdly, we'll reinvest capital back into the mine to optimize the resource and thereby squeeze more out of it in the long run. And this means surplus cash used to reverse some of those expedient decisions that we had to make at the outset because of the cash constraints. So in other words, consider buying new, more efficient trucks, and yes, this time for real, an investigation of renewables. So in our case, we expect to achieve positive cash flow next year and be in a position to start examining potential renewable solutions by 2017. What the solution will be will no doubt come forward from the attendees in this room today. The Free State receives the second highest level of solar radiation in the country, and we're creating very large flat surfaces free of shadow on the top of all of our slime dams. So maybe solar PV has a role. But whatever the solution, it will need to be a solution which works in conjunction with our existing Eskom grid tie. And importantly, we are miners, not renewable experts. So we almost definitely need to be a joint venture with a renewable power specialist where we commit to the offtake. So this then, I believe, is where we'll see a lot more juniors moving with mining projects which can access the grid. A conventional startup with grid tie, then a progressive move to renewable joint venture once positive cash flow is achieved. For those mines which are off-grid in remote locations, startup may start with diesel gensets and reinvest in renewables to some form as positive cash flow is achieved. But increasingly, these junior companies are going to have to look at a proportion of renewables even at the startup phase, as Gem Diamonds did with their Gagu diamond mine in Botswana last year. So, there's no doubt in the years ahead that CEOs of junior mining companies have to know more about their renewable options. So I therefore think that this conference must become an essential date on the calendar of any junior mining CEO. So as a CEO with next to no experience in renewables, I hope these comments on the cash constraints and capital allocation decision-making processes inside a junior has been of some interest to you, and give you some insight into where renewables fit within the junior sector and how some of you need to pitch potential solutions to us. So I look forward to continuing to learn more about the options available to us and the trends emerging in the sector, and having the invaluable opportunity of networking with some of you over the rest of the day. Thank you.